Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, support and resistance, the bones of every chart.
Yes.
And before we really get into it, I want you to imagine billions of dollars, armies of quantitative analysts, and, supercomputers executing trades in milliseconds.
Right. The whole modern financial machine.
Exactly.
Yeah.
Now imagine all of that being consistently outsmarted by the human brain's bizarre obsession with the number zero.
This is wild. Yeah.
It sounds totally absurd, but that little quirk of human psychology actually dictates where fortunes are made and lost in the financial markets. So today, our mission for this deep dive is to decode the hidden architecture of stock charts.
Absolutely.
We are pulling insights from Investopedia and the CFA Institute to understand how these invisible levels, these historical price points, can really help you read the market's underlying structure. Because we want you making informed decisions, not just, throwing darts at a jagged line on a screen.
Yeah. And it is remarkably easy for anyone to just get lost in the noise of a chart. I mean, you pull up a stock's history, and it just looks like erratic spikes and terrifying drops.
Totally. Just pure chaos.
Right. But underneath that apparent chaos, there's actually a rigid, mathematical, and deeply psychological structure. And that structure is built on support and resistance.
The bones of the chart.
Exactly. At their core, these are the fundamental building blocks of technical analysis. There are specific price areas where the value of a security consistently stops and, well, reverses direction.
Okay, so how do you actually spot them?
You identify them by looking for historical points where the price was rejected multiple times without breaking through. So a support level is where a falling price tends to halt.
Okay.
It drops to a certain point, the market perceives it as a bargain, demand floods in, and the price rebounds instead of falling further.
Makes sense.
And resistance is just the inverse. As a price rises, it hits a historical level where selling interest overwhelms the buyers. Holders decide to take their profits, and the price recoils downward.
I always visualize this as like a room, so the support is the floor.
Yes, I like that.
The price drops, hits the floor, and because the demand from buyers is strong there, it bounces back up. And then the resistance is your ceiling.
Right.
The price rises, hits the seller, stepping in at the ceiling, and it gets knocked back down. But, if we move past the visualization, if this is just about bouncing between a floor and a ceiling, why does it actually matter so much to investors? Why should you, sitting at home managing your portfolio, care about some arbitrary floor that a stock hit 6 months ago?
Well, because mapping out that room provides a tangible roadmap for risk management.
Okay.
Institutional traders and retail investors alike use these historical turning points to protect their capital. Understanding where the floor and the ceiling are is actually the primary way traders set stop-loss orders.
Oh, right.
If you buy a stock right at support, meaning you're standing on the floor, you know that if the floor suddenly caves in and the price drops significantly below that level, well, the underlying thesis for your entire trade is probably wrong.
Right, the demand you thought was there has just evaporated.
Exactly. So by placing a stop-loss order just below that support zone, you cap your potential downside.
Yeah.
It allows you to basically define your risk before you ever even enter the trade.
Okay, so let's test the mechanics of this with a concrete example.
Sure.
Say we have a stock trading in a very clearly defined range. The support floor is $50, and the resistance ceiling is $60.
Okay, pretty standard.
Right. So it falls to 50, demand surges, it rebounds, it reaches 60, sellers take their profits, it falls back down. It is essentially trapped in this $10 room.
Yep.
But wait, if everyone looking at the chart knows the ceiling is $60, wouldn't smart money just sell at $59 to beat the crowd? Doesn't the anticipation of the ceiling actually, lower the ceiling?
Oh, that phenomenon absolutely happens, and it's a concept known as front-running the level.
Front-running, okay.
Right. Traders know this massive block of sell orders is sitting exactly at $60. So they set their sell orders at, say, $59.90 or $59.50 to ensure their orders get filled before the price hits the ultimate wall and collapses.
So they're cutting in line, basically.
Exactly. And this is precisely why the ceiling isn't a razor-thin, impenetrable barrier. The selling pressure begins to increase as the price approaches the resistance level, causing the momentum to sort of slow down and eventually reject the higher prices before it even hits the exact dollar mark.
Okay, that makes the chart feel much more like a living, breathing ecosystem rather than just a static piece of math.
It really is.
But what happens when the ball hits the ceiling too hard? Does the ceiling ever break? If there is an incredibly positive earnings report, the price can't just consolidate between 50 and 60 forever, right?
No. Eventually the ceiling shatters. If the price pushes through that $60 resistance with heavy momentum and high trading volume, it achieves what we call a breakout.
A breakout. Got it.
The price action will typically continue to accelerate upwards until it eventually encounters a brand new ceiling, a new level where sellers decide the valuation is finally too high.
Hmm.
But, and this is the most crucial mechanic to understand, you have to look at what happens in the aftermath of that breakout.
Okay, what happens?
The old ceiling, that previous resistance at $60, frequently transforms into the new floor.
Wait.
The resistance becomes the new support.
Okay, stop right there because that feels incredibly counterintuitive.
I know it does.
Why would sellers who literally just decided $60 was the perfect place to dump their shares suddenly become the buyers defending that exact same price point?
It is entirely driven by the psychology of regret and missed opportunity.
Oh, FOMO.
Exactly, financial FOMO. Think about the trader who sold their entire position at $60, feeling like an absolute genius, only to watch the price violently break out and climb to $70.
Ouch. Yeah.
They're experiencing intense seller's remorse. So they tell themselves, if this stock ever pulls back to $60, I am buying my shares back.
Right.
And then you also have the sidelines crowd, the traders who hesitated and missed the breakout entirely. They are desperately waiting for a dip to get in on the action.
So they're all watching that same $60 mark.
Yes, all of that concentrated, pent-up buying interest converges around the old $60 mark. The market's collective memory transforms the old area of supply into a new area of intense demand.
That is fascinating. It's entirely human emotion mapped onto a grid.
It is. And that introduces the concept of testing. When a price returns to that new $60 floor and rebounds, we say the level has been tested.
Okay.
And the more a level is tested and successfully holds back the selling pressure, the more significant that level becomes in the eyes of the broader market. It proves that the demand at that price is real and sustained.
All right, so knowing what a floor and ceiling are is great. We understand the psychology of the room. But if I pull up a fresh chart, I don't see floors and ceilings. I just see a mountain range.
Right.
How do we actually map this out? Because knowing how to map out a room you've never been in is the real trick here. The CFA Institute material mentions a whole toolbox of methods.
Yeah, we can categorize the tools for spotting these invisible lines into two distinct camps. You have reactive methods and you have proactive methods.
Okay, let's start with reactive.
Reactive methods are strictly based on historical data. They're formed as a direct result of past price action or volume behavior. You're basically looking backwards to see where the market has previously rejected a price.
Give me an example.
A prime example of this is a tool called the volume profile.
Okay, I'm going to need an explanation of volume profile because standard volume is just those little vertical bars at the bottom of the screen showing how many shares traded on a given day, right? How does that help me find a ceiling?
Well, standard volume shows you when the trading happened. Volume profile flips that axis entirely.
Oh.
Instead of displaying volume along the bottom of the chart by time, it displays a histogram on the side of the chart, mapping volume by price.
Okay, I see.
It creates a visual heat map showing exactly how many shares changed hands at $50 versus $55 over a specific period.
Ah, so instead of knowing that 10 million shares traded on Tuesday, volume profile tells me that over the last year, 50 million shares traded exactly at the $55 mark.
Correct. At a price level with a massive spike in historical volume, we call a high volume node, is highly likely to act as strong support or resistance.
Because everyone remembers it.
Right. It represents a price where the market previously found overwhelming agreement on fair value. If the price strays far away from that node and then eventually returns to it, it was returning to a massive cluster of trapped buyers and sellers who are very likely to defend their positions.
Wow. Okay. Are there other reactive tools?
Yeah. Another reactive method is simply identifying price swing lows and highs. You literally look at the chart, find the prominent V-shaped dips where the price aggressively rebounded, and draw a horizontal line connecting those historical pivot points.
So those are literally the footprints on the floor. We are just looking at where the market has already been.
Exactly.
But you also mentioned proactive methods. How do you proactively map a ceiling the price has never even touched before? That sounds a bit like, trying to read tea leaves.
It sounds like it, but it actually involves forecasting based on market geometry and momentum. Proactive methods outline areas where the price hasn't actually been yet, but where it is mathematically probable to go.
Okay.
Traders use techniques like measured moves or swing ratio projection.
Whoa, back up. Swing ratio projection sounds like a chapter out of an advanced physics textbook.
I know, it's a mouthful.
What does that actually mean for the listener trying to evaluate a stock?
It is a lot simpler than it sounds. Markets often move in symmetrical waves. Let's say a stock rallies from $10 up to $20 on a $10 upward swing.
Right.
It then hits resistance and pulls back to $15. A trader, using a measured move, will project the size of the initial $10 rally onto the new $15 low.
Oh, I see.
They will forecast that if the stock breaks out again, the next major resistance level will be $25. They are proactively drawing a ceiling based on the geometric proportion of the previous trend.
So they're assuming the market has a rhythm. If it took a $10 stride last time, it's likely to take a $10 stride next time.
Yes, exactly.
Yeah.
They will also use tools like Fibonacci retracements to find mathematical ratios that markets surprisingly tend to respect, and they project those ratios forward to find future ceilings.
Okay.
And they use mathematical pivot point calculations, taking the high, low, and closing prices of the previous trading day to automatically generate a formulaic map of potential support and resistance levels for the current day before the market even opens.
So we are talking about advanced geometric projections, high-volume nodes, and Fibonacci ratios. This is heavy quantitative stuff.
It is.
But there was a detail in the CFA Institute notes that felt completely out of place next to all this advanced math. It was about the psychology of round numbers.
Oh, yes. The CFA Institute deliberately highlights that regardless of what the complex algorithms and geometric projections say, simple round numbers act as massive psychological barriers.
Really?
We were talking about levels like $100 or $50 or even increments like $1.50 for a penny stock. The human brain craves clean, round numbers to simplify complex information.
You know, this reminds me of everyday consumer psychology. It's exactly like why stores price things at $19.99 instead of $20.
Yeah,
Our human brains just get hung up on those big round numbers. We see 20 bucks and think, oh, that's too much. We see 19.99 and our brain categorizes it as a bargain. And you are saying that exact same primitive consumer psychology plays out on massive institutional stock charts too.
It plays out on a massive scale. Think about it. When a retail investor decides to sell a stock, they rarely type in an order to sell at $97.34.
Right.
Nobody does that. They say, if this hits $100, I'm out. When millions of market participants all independently fixate on the exact same round number, it creates a self-fulfilling prophecy. A massive wall of automated sell orders piles up exactly at the $100 mark, purely out of human habit.
Wow.
That creates a brutal resistance ceiling that has nothing to do with the underlying fundamentals of the company and everything to do with the fact that humans like zeros.
Well, if human psychology is involved and we are influenced by something as arbitrary as our preference for the number zero, humans are bound to make mistakes.
Oh, constantly.
Let's smoothly pivot to where traders get this wrong. Because if I'm drawing these lines on my screen, I want to know where the traps are.
The single biggest trap, the misconception almost everyone falls into when they first start learning technical analysis, is the exact price myth.
The exact price myth.
Right. People read a chart, see a historical rebound at exactly $50, and they draw a razor-thin, impenetrable laser beam across their screen at $50.00.
I mean, I would probably do that.
Most people do. They treat that line as absolute law. But in reality, support and resistance are not lines. They are ranges. They are zones.
So relying on the floor analogy from earlier is actually a bit dangerous.
It is, yeah.
It's less like hitting a solid concrete floor and more like, I don't know, jumping onto a trampoline net.
Oh, trampoline is the perfect way to look at it.
There's a bit of give and fluctuation before the bounce happens. The price might push down, stretch the fabric of the trampoline a bit, and then launch back up. The ball could realistically dip to $49.70, momentarily breaking your laser beam line before the demand kicks in and it rebounds.
Exactly. The price action is going to fluctuate within these zones before a true reversal or a true breakout is confirmed. If you treat support as an exact penny-perfect line, you are going to get burned.
Makes sense.
If you set your stop-loss order exactly at $50 because you think it's a concrete floor, market makers and normal volatility will often push the price to $49.90, bump you out of your trade for a loss, and then immediately rebound back up into a profitable trend.
That would be so annoying.
It's the worst. You have to give the support and resistance zones breathing room.
That seems like an incredibly frustrating lesson to learn the hard way. Giving the zone breathing room requires a lot of patience. Are there other major analytical traps traders need to avoid?
Definitely. The danger of the single indicator. Investopedia strictly warns against relying too heavily on just one method to map your charts.
Because it's too narrow.
Right. You might draw a beautiful proactive trend line using a measured move and think you have the market perfectly forecasted. But if you ignore the reactive volume profile, you might completely miss the fact that there is zero historical trading volume to actually support the ceiling you just drew.
So you're just drawing lines in the sand.
Pretty much. You absolutely must combine multiple methods to find areas of confluence where the proactive geometry and the reactive historical data point to the exact same zone.
But even if I combine a trend line with a volume profile, does any of this matter if the broader market is collapsing? Like if there's some huge economic crisis, is my $50 support floor going to save me?
Not at all, and that is a really critical point. A strong support level on a chart might mean absolutely nothing if a major macroeconomic catalyst occurs. You have to factor in broad economic indicators and overall market trends.
Right.
Technical analysis does not exist in a vacuum, which actually leads directly to the next major pitfall.
Yeah.
The illusion of permanence.
I was wondering about this. Do these zones ever just disappear? Because the way we have described this, it feels like once a floor is established, people will just keep using it for decades.
But they absolutely disappear. Some traders mistakenly believe that once a historical support or resistance level is established, it is carved in stone forever. But the reality is that the market's memory fades as structural conditions change. An old resistance zone from 3 years ago might be completely irrelevant today because the company itself is fundamentally transformed. Maybe they released a revolutionary new product, or maybe their entire sector went into a recession.
So the context changes.
Exactly.
Yeah.
The underlying valuation shifts, rendering the old lines obsolete. You cannot simply draw your zones once and treat them as permanent architecture. It requires continuous monitoring and constant adjustment as the overall market sentiment shifts.
So the ground is literally always shifting underneath you as the macroeconomic weather changes.
It really is.
Well, since the room we are navigating is constantly changing shape and the walls are made of elastic trampoline fabric instead of concrete, you, our listener, need a rock-solid set of rules to anchor yourself.
Definitely.
Let's distill everything we have unpacked today into some rapid-fire key takeaways.
First, abandon the laser beam. Support and resistance are zones or ranges, not exact lines.
Remember the trampoline?
Yes. Price action will often stretch the fabric of a zone before rejecting or breaking through. Factor that elasticity into your risk management.
Second, avoid the single indicator trap. Combine your proactive forecasting methods with reactive, volume-based data. Look for that confluence and never ignore the broader macroeconomic environment.
Third, respect the power of human psychology. Remember that round numbers literally move markets. Keep a close eye on those zeros because human behavior is consistently fixated on clean milestones.
And finally, recognize that markets evolve. A floor today is not guaranteed to be a floor next year. You must constantly adjust your levels as sentiment shifts.
Exactly.
So we have covered the conceptual framework, the mechanics, and the psychology. But to actually utilize these tools effectively, you really have to practice mapping them yourself.
You do.
We highly encourage you to continue your education beyond this deep dive. Dive into comprehensive books on technical analysis or explore structured online courses. Specifically, look for materials that cover Investopedia guides or CFA Institute curricula to master these chart fundamentals.
They will walk you through the precise mathematics of all of this.
Exactly. Now, as you continue exploring this field, we want to leave you with one final, lingering question to ponder on your own.
Yes. We established earlier that the more a price level is tested or bounced off of, the stronger it is considered to be by the market. But if you think about the real world, if you keep hammering relentlessly at a ceiling, eventually it cracks.
Right.
So at what point does a heavily tested support or resistance level stop being a concrete barrier and start becoming a fragile, exhausted breaking point ready to shatter?
That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.